Gold has been threatening to break below major support for a couple of weeks now, but that eventually came at the start of this week as US economic data cast doubt over global economic growth, further confirming other reports which we have seen around the world. The data, of course, refers to the manufacturing PMI, in this case the ISM manufacturing PMI, which slipped unexpectedly into contraction territory. Again, this is nothing new when we're looking at other areas of the world. Germany already is seeing levels of manufacturing that we haven't seen since the global financial crisis more than a decade ago. But the fact that this is now spreading to the US and also in other countries spreading to the services industry, which is widely seen as being more important, this has had a negative impact on sentiment. We saw stock markets on Tuesday actually selling off on the back of the result. Interest rate expectations also being cut for the US, with a rate cut now more heavily priced in than it was before. What this means for gold is that we have seen a little bit of a resurgence over the last 24 hours, but the actual outlook for gold hasn't necessarily changed. If we take a look at the chart, you can see that that key support level that was broken was $1,480. Again, this is a level that had been tested for some time, but was starting to look very vulnerable after the most recent sell-off. We broke below here and we tested 1460 as initial support, and since then we did see a little bit of a rebound following the release of that data. The reason why gold rebounded following the release of the data is again because of what it means for interest rate expectations. More rate cuts means a weaker dollar, which tends to mean a stronger gold. Gold, of course, is priced in dollars, so when the dollar is weak, it makes it more affordable for non-dollar buyers. That's one of the justifications. But also, as we've seen back over the years, when we saw more interest rate cuts, when we saw more quantitative easing, which is what we're now seeing, for example, from the European Central Bank, that inflated gold to close to $2,000. At this moment in time, we're still a lot shy of that, and I think the downside potential for gold in the near term is a little bit greater. What's interesting right now, though, is with 1480 having been such a solid level of support for quite some time, we're now testing it from below. From a purely technical analyst perspective, this could be a very interesting test. If we break back above here, that doesn't necessarily spell the end of the downside for gold. However, if we do remain below these levels and that now acts as a barrier of resistance, that's technically quite significant. That is seen as confirming the initial breakout. When support turns resistance, that is seen as confirmation, and therefore that is technically a bearish signal. If we do see it rotate off these levels, then again 1460 becomes a very interesting level of potential support in the near term for gold. But I think if we do rebound off these levels, then actually 1460 will also now start to look very vulnerable, with 1450, 1440 below that being the next potential area of support. But again, the decline here in gold could be a little bit more significant. You'll see on your chart here that we've got what looks like a head and shoulders formation. The head, of course, around those 1560 highs, and the two shoulders prior to that around 1535. What this gives us is possible price projections, and the possible price projection here from the head to the neckline, which is that 1480 level, projected below, gives us a possible projection level of close to $1,400. So again, that suggests that we could see a bit more of a decline here. Of course, compared to the rally that we saw prior to that, that is not a hugely significant correction. Corrections do happen in markets. I think most people agree that the longer term prospects for gold are still bullish, but these corrections along the way are very, very healthy.